All right, let's talk exams. You've got one coming up. And this topic, capital budgeting, is a huge deal. We're talking about 40% of your grade. So let's use the next few minutes to build a super focused study guide and make sure you have these concepts totally locked down. Okay, let's dive right in. Think of these next few slides as your secret weapon. We're going to walk through the exact kinds of problems and ideas you'll see on the test so you can walk in there feeling totally prepared. Everything we're about to cover really just boils down to answering this one simple question. Is this a smart move? Managers have to make these kinds of calls all the time, and capital budgeting is the toolkit they use to get it right. So here's our game plan. We'll start with the investment decision itself, then we'll add 4 essential tools to your kit one by one, and at the end we'll do a quick recap to pull it all together. Let's get started. First up, the investment decision. This is where we'll set the stage, define what we're talking about, and introduce the case study we're going to be working with for this entire review. So what even is capital budgeting? Don't let the fancy name fool you. It's really just the process companies use to figure out if big, long-term investments, like buying a new building or a fleet of trucks, are worth it. It's how we're going to answer that question about the $150,000 machine. And here are the numbers pulled straight from your exam review sheet. This is the Boulder Court project. They're looking at a machine that costs $150,000 up front. You can see the cash it's expected to generate each year, plus what it can be sold for after 5 years. That's the salvage value. And that last number, the 8% required rate of return, is crucial. We're going to use all of these numbers for the rest of our calculations. Okay, time to grab our first tool from the kit. This is the payback period. It's the simplest of the bunch, and it's all about answering one really basic question. How fast do we get our initial cash back?
So here's the thing you got to remember about this one. It's not about how profitable the project is overall. It's all about speed. It's a quick and 30 way to gauge risk. Because hey, a project that pays for itself faster just feels less risky, right?
Now let's calculate it. It's pretty straightforward. We're just keeping a running tally. We start day 1 in a $150,000 hole. After year 1, we get 45 grand back. So now we're only down 105. After year 2, another 40, and so on. See what happens between year 3 and year 4? We go from negative to positive. That's our payback window. And here's the exact number, 3.77 years. How do we get that? Well, at the end of year 3, we still needed to get $27,000 back. And we know that in year 4, the project is going to bring in $35,000. So you just take what you still need, the $27K, and divide it by the cash you'll get that next year, the $35K. That gives you 0.77. Tack that onto the 3 full years, and there's your answer. Okay, on to tool number 2. Now, the payback period is useful for a quick check on risk, but honestly, it has 2 massive flaws. First, it ignores that money today is worth more than money tomorrow. And second, it completely ignores any money the project makes after it's paid back. That's where net present value, or NPV, comes in. It's our most powerful tool because it tells us if a project will actually make the company richer. This little phrase is the core idea behind NPV. It's simple, right? You'd rather have $1 now than $1 a year from now, because you could invest it and earn a return. Because money has this time value, we have to discount all those future cash flows to see what they're really worth in today's dollars. It's the only way to do a fair apples-to-apples comparison. Okay, now this is where the magic happens. We're going to use that 8% required rate of return. For each year, we grab the present value factor from the table in your review sheet. Then we just multiply each future cash flow by its factor. See how $45,000 next year is only worth about $41,670 today? We do that for every single inflow, and don't forget the salvage value. Then we add them all up. So we take that total, $168,621, and we subtract our initial cost of $150,000. And what do we get? A positive $18,621. This leads us to the most important rule in all of finance. If NPV is positive, you accept the project, period. It means the project is earning more than our 8% requirement, and it's going to create real value. All right, so what if you have a great problem to solve? What if you have multiple projects that all have a positive NPV, but you only have enough money to do one of them? NPV tells you if a project is good, but it doesn't really help you rank them. For that, we need our third tool, the profitability index. The profitability index, or PI, is just a simple ratio, but it's incredibly useful. You take the present value of all the cash coming in, and you divide it by the initial investment. What that tells you is how much value you're creating for every single dollar you put in. It's the ultimate bang for your buck calculation. So let's bring in a competitor. Project A is our machine that we've been analyzing. But now let's look at Project B. It's a bigger investment, $200,000, but it also generates a higher total present value of cash flows. So which one is actually the better deal? Which one is a more efficient use of our money? And this slide right here shows you why the PI is so great. For our Project A, we get a PI of 1.12. That means for every dollar we invest, we get $1.12 back in today's money. Not bad. But look at Project B. Its PI is 1.17. So even though both projects are good, Project B is slightly more efficient. It gives us a better return per dollar. If we can only pick one, PI says we should go with B. Okay, time for our final tool, the internal rate of return, or IRR. Now for your exam, this one is more of a conceptual tool than a calculation tool. It's a way to sum up a project's potential into a single, easy-to-understand percentage. You are not going to have to calculate this on the exam, but you absolutely need to know what it means. The IRR is the project's true rate of return. Think of it as the break-even interest rate. It's the exact rate that would make the NPV of the project equal to 0. And the rule is super simple. If the project's IRR is higher than your required rate of return, you accept it. Phew, okay, we've covered a ton of ground. We've filled our toolkit. Now let's just do a quick recap to organize everything so it's fresh in your mind for the exam. So remember it this way. 4 tools, 4 different questions. Payback is all about speed. NPV is all about creating value. PI is about efficiency and ranking projects. And IRR tells you the project's own built-in rate of return. If you know what question you're trying to answer, you'll know exactly which tool to pull out. And that's a wrap. I'll leave you with this question to think about as you study. If it were your own money on the line, what would matter most to you? Getting your cash back fast or maximizing the total value you create even if it takes longer? There's really no single right answer, but understanding what you're optimizing for is the real key to making smart decisions. Now go ace that exam.